Okay, it's Tuesday, July 21st. We're 5 minutes into market open. Off rip, if I'm on the 1 day time frame, I had this bullish flag marked right here, right? We've taken out the lowest point in the bullish flag from this Friday candle right here. Not only that, but that Friday candle in relation to this July 8th Wednesday candle, we have an SMT divergence. What I'm saying is ES has not taken out that Wednesday candle low. So ES is trading somewhere around here, whereas NQ has taken out that low. Not only that, but this Friday candle from July 17th has entered this 1 day very clear bullish fair value gap, generating even more bullish momentum in price. So I could predict that for the rest of the week, we'll probably tread bullish, but we're taking trades on a lower time frame. So I'm going to look at the 4 hour. On the 4 hour, I see this clear 4 hour bearish fair value gap and 4 hour bearish order block that's marked up here. If price reaches this point, I'll know to either sell a contract or that we might short, but this is probably price will probably reach here later this week. Right now, we're left with 3 bullish candles, and these are continuation candles. Sure, the candle body in the third is not as long as the first and second, but what makes this not that clear of a fair value gap is because the candle body of the first and third candle are not closing within the wicks of the second candle. The second candle has short wicks and the bodies are protruding out of it, which shows that there is more buying pressure. This is a continuation sequence, and that is proven correct by market open taking out this candle high right here, which also ends up being London highs. So that doesn't take away from the fact that there is inefficiency here. For example, on the 1 hour time frame, you have this 1 hour intermediate low. What makes it an intermediate low is that it's within a bullish fair value gap. And this is what I mean when I say the candle body of the first or third candle being within the wicks of the second. You see the wick of this second candle? It is taller than the body of this third candle. So that is what makes it a valid fair value gap. Price tested that fair value gap, continuing price, right? Now, let's assume this fair value gap wasn't here. Naturally, if price takes out a high or a low, it will generate liquidity for the opposite direction. If we take out a low, it'll generate some buy-side liquidity. If it takes out a high, the opposite. But the fact that it's within a bullish fair value gap just makes it even more likely for price to hypothetically come down here, generate liquidity that will push price bullish, right? So that's marked. I have another intermediate low right here. Same idea. And this intermediate low, though, I think has a higher chance of price reacting at because it coincides with London lows, right? So not only would we take out London lows, but we'd enter this 1 hour bullish fair value gap, which also ends up having an intermediate low. So those are 3 factors, really 2, because the fair value gap is what makes it an intermediate low. But the fact that there's London lows there as well makes this a higher liquidity level in comparison to this. Another reason why I feel that price might want to pull down is because we have a bearish SMT divergence. So even if we take this high, ES has not taken out this 9 a.m. Monday wick right here. It has not, which is previous day high. So ES has not taken out previous day high, whereas NQ has. And when you see an SMT divergence, that doesn't mean it's going to drive price in the opposite direction for the rest of the day, and that's the direction that price will settle at. What I mean is, just because we see a bearish SMT divergence doesn't mean that we're going to be long-term bearish, and that's where price is going to settle somewhere down here. No. It's often used for both pairs to find an equilibrium, find a balance in a discount zone so that it can continue in the dominant trend direction. In this case, the dominant trend direction is bullish. So a bearish SMT will retrace price into a key level, into a discount zone, finding its equilibrium, and then continuing in the dominant trend direction, which is what I think might happen to price. You know, we might take out this intermediate low, or we might take out this one right here, which conflicts with London lows. That's my prediction. If we look at the 4 hour here, just seeing how price is rejecting at this level, we don't really have any inefficiency on the buy side. There's no inefficiency up here. The only one we really have is this 4-hour bearish order block and fair value gap, which is how many points away? I mean, we have time. We might not even have to worry about it today. Yeah, 330 points away. So I don't see anything on the 4-hour. On the 1-hour, don't see any inefficiency as well. And I'm just looking for a gap. That's all I'm looking for. Is there a gap in price right here that we could be currently filling, rejecting off of, and then maybe the narrative has changed and we're looking for shorts? But I don't see that. So I'm pretty confident in longs. What makes me confident is that we have bullish structure right here. We have sell side. We have sell side inefficiency right here that price could react at, a bearish SMT divergence to actually drive price to that level. And then there's no bearish inefficiency here that price could be rejecting off of and causing price to be long-term bearish and changing the bias to bearish for the day. So I'm looking for longs. I think this is a good take profit level, assuming that let's say we take a long at this level or we take a long at this level, we could have our take profit where we close out our positions at this point right here. I think that's kind of what price just created. But until we reach these levels, there's really nothing to do. So I'll pause and I'll resume once we're right around there. All right, so what I'm seeing now is what price should look like for an entry, right? I mean, we have this 1 minute bearish candle right here. We have a strong candle body slamming right through the second candle in that bearish fair value gap sequence, proving selling pressure to be invalid. I think, yeah, I just see it on the 1 minute, but it's a clear displacement candle. The only issue is that we did not take out this intermediate low / London low. So even with seeing that, if price ends up taking out these highs, I'm comfortable with not entering because that's our strategy. What will create more momentum for price? And that is taking out sell side liquidity, which in this case is this intermediate low on the 1 hour, I believe. Yeah, 1 hour and London lows. If price is not going to take that out, then entering longs at this 1 minute inverse is not going to give us a high enough likelihood of price hitting that 1-to-1 ratio, that 2-to-1 ratio. And right now, I mean, it might be evidence of that. Watch price come down here and take this out. It's very possible. I think what's going to happen is right around here, price will probably drop and sweep this liquidity because everyone who entered a buy position over here thinking this was our inverse fair value gap, the people who entered a buy position here prematurely have their stop losses here. And if you're in a buy position, the way to close it out is that you sell. So I'm curious to see how price will react right around this level. Right now we're selling out all the retail traders who entered buys prematurely. And then my prediction is I think we should just react right here. But it's possible that we end up taking out this intermediate low, which is a little bit lower, and then continuing in the dominant trend direction. But yeah, 1 hour and 4 hour time frame finished not long ago. This is a pretty bearish candle right here, this bearish doji, but we have to think big picture. We have inefficiency here. We have a bearish SMT divergence. This bearish SMT and this bearish doji candle with the small body long wicks, that is for sure going to drive price down as it is doing right now, but it doesn't mean we're long-term bearish. It doesn't mean that's what price is going to close out at. Because we have to understand the market structure is bullish right now, right? We have to understand the confluences that we've targeted and the inefficiency that we have here, which can generate liquidity for price to continue bullish. So that's what we're going to wait for. Any second, price should take out this London low. Oh, we just swept it. So I'll see if we tread lower. And if not, I will resume once I have confirmation of the trade carrying out. Not even carrying out, just confirmation that the trade is happening right now. And once I see that point, then I'll resume and we'll find out our risk, how many contracts we want to buy, and we'll go from there. Okay, we just had a candle body close on the 30-second and the 1 minute. So I'm going to set a order filled for 2. Stop loss is down here at 379. inverted this 1 minute bearish fair value gap right here perfectly. If we retrace down to this 50% level, I will add one contract because we're going max risk 500. And then we're going to target a 1-to-1. Honestly, this high right here is sufficient. You have to understand, like right now, this is not a pure 1-to-1. It's just under. And the reason why I'm not making it a 1-to-1, even though 1-to-1 is ideal, it's a 0.94-to-1, is because we're talking about this high right here. At a high, who knows what could happen with price once we sweep that high, generate some kind of liquidity to pull price back down, end up taking out our stop loss. It's just not worth it for a 0.06, right? So it is a 1-to-1. You don't have to be on the dot, especially if there's a high right around that 1-to-1 ratio, which is a little bit lower than that take profit point. So yeah, again, if price pulls back down to this level right here, I will limit by one. And if not, we'll take that 1-to-1. I'll resume once we hit stop loss or TP. All right, we're right around that 1-to-1 ratio. Almost going to hit our take profit. While we kind of hit it and the contract closed. Very simple trade. This is a textbook setup, A+ setup. All we're looking for is we look for any inefficiency. We establish what our daily bias is first. What direction is the market treading? If we drop down to the low time frame, 15-minute, 5-minute, we'll see a clear change of character from these highs over here. And then when you go to the 1 hour, we have this intermediate low lined up with this London low, price perfectly sweeping that low. And prior to this sweep, this downtrend, this impulse move to the downside, not even impulse move, just this temporary downtrend to take out sell side liquidity and enter a bullish confluence. Like, you have to understand, sell side liquidity and bullish confluence, those two things together can drive price. That move to the downside was substantiated by this bearish SMT divergence. Like I mentioned, a bearish SMT will not necessarily establish where price will settle for the rest of the day. It will just bring price into an equilibrium, a balance, a discount zone, where then we can target a high time frame confluence, and then we'll look for our confirmation. And our confirmation was simple. We want to invert a low time frame fair value gap in the opposite direction. So what's the direction we're looking to trade? Bullish. I'm looking for now a clear bearish fair value gap that we invert. This is kind of continuation. Yeah, I see inefficiency, but we respected it and we continued lower. There was this bearish fair value gap right here, candle 1, candle 2, candle 3, that we did not respect, and instead we had a high volume 1 minute bullish candle slam right through the second candle in that sequence, and that's exactly when we entered our trade. This confirmed to us that any selling pressure at this point is now invalid. It is low in strength. It is not enough to flip our position, and from that point on, just target the next high, especially if it's a 1-to-1 ratio, and establish your stop loss. And I have a rule in place that if I'm 80% of the way to my take profit, I will move my stop loss to break even. So just to kind of explain. I guess let me flip it the other way. We already reached 80% of the way to my TP. When we reach 80% of the way, I will move my stop loss to break even. So now this is a risk-free trade. That if this hits my stop loss, I'm no longer in the position. And chances are, from just back testing and hundreds of hours of looking at candlesticks, I've noticed that when price is 80% of the way to my TP and it flips, by the time it reaches your break-even point, it might as well have taken out your stop loss down here, because it will. It will just flush the entire position. So 80% of the way, you're almost at your take profit. If price reaches all the way down to your break even at that point, then we've almost, like, we lack enough liquidity on the sell side to continue bullish price action. So that's why stop loss is not break even, and we'll wait for it to hit either that or our TP. All right, order filled, hit our take profit. So yeah, perfect. Came back down to our 20% range and ended up retracing back up from there, taking out this high. Perfect 1.1 to 1 ratio, $572 on the day.